Hi, this is Chris Coward with my final E86 project, Getting Rich Quick in the Stock Markets with Deep Neural Networks, or at least trying to. I took a look at the exchange-traded fund market. The exchange-traded fund market is a set of securities that trade on the New York Stock Exchange, and they're very simple because all they own is a portfolio of other liquid listed securities. This typically makes them very easy to value because they tend to track the value of their underlying assets, which is quite visible. However, uh, I took a look at a specific one, EWA, the MSCI Australia ETF, and this one only holds securities that are listed in Australia. Now, EWA trades, however, on the New York Stock Exchange. This makes it quite tricky to value because all of its underlying assets trade in a different time zone. So while it's trading here, we have no idea about if valuations have truly changed in the Australian market. There are, however, a number of important metrics that are visible in the US time zone that can give us very powerful hints as to what EWA's assets should be worth. These metrics broadly comprise of indicators of market sentiment, risk appetite, and market regime metrics, currencies and commodity prices, as well as other metrics that give us specific indications on Asian asset valuations. I used all of these metrics as inputs into my model for the purpose of predicting the return of EWA from its closing price in the US to the opening price the following morning. And so the input was that day's returns for all of these US metrics to predict the overnight return in the EWA stock price. I looked at a number of permutations of possible models for this purpose and ultimately settled on a relatively simple dense network with a little over 1,000 parameters. I found that for a model of this relatively small size, the CLU activation function worked the best. That didn't surprise me because I think for ReLU activation, if there's a sufficient number of nodes that go negative or go dead, this type of sparse network can become less powerful quite quickly. So not surprising that CLU worked well. It also was not surprising that dropout layers were not that additive for a similar reason, given such a small network. And also, importantly, I chose to use a MAE, or mean absolute error loss function. I think in finance, all too often, many practitioners use mean squared error due to history, whereas mean absolute error very often can be much more powerful, particularly given that there's no way to square money or actually try to in real life actually try to optimize for squaring valuations. It also is a market with a substantial amount of kurtosis, and overly emphasizing outliers that may or may not transpire the same way in the future tends to produce more error than it does benefit. Once I ran this model, I then asked myself, is this model really any better than a simple linear regression or a simple linear optimization of these parameters? And I took a look at that by just simply focusing on the training data and measuring how the predictive power generated from a simple linear optimization model, which I created separately, compared to the predictive power of the neural network the dense neural network that I just created. And the predictive, and this again is just on the training data, just to understand if this neural network is really claiming to have found interesting relationships. And what that showed was that the neural network model uh, actually had a predictive power on the training data about 400% greater than the linear model. So at least on this training data, the deep model was claiming to have found nonlinear relationships that materially improved the explanatory power of the relationships between these variables and EWA. Whether or not this would allow us to predict future prices is in out of sample data is yet to be seen. I then attempted to make a number of modifications to this simple base model. The first one I tried was to add a recursive term where for day two, I added one additional input into the model, which was the cost of the output of day one. So for each subsequent day, I added yesterday's cost to the model. The purpose for this was to give the model an additional degree of freedom of understanding if there were recent errors in its prediction, and if the model was identifying, it would allow the model to effectively identify short-term mean reversion or short-term momentum characteristics in the time series data. This has some analogies to a much more sophisticated LSTM model, but far less parameterized, far less likelihood for data mining, and this serves a very, very specific purpose with respect to time series data, about just giving it a little bit more information about recent errors that may self-correct. What this did in fact show was it did not actually make material improvements over the original base model. My interpretation of that is that the markets are efficient, at least efficient enough, such that historic data lagged 1 or 2 days is not powerful in predicting future stock prices, which is not surprising and somewhat reassuring. Another model modification I made was to add all of the interaction terms between my 22 variables explicitly. So increasing the size of the input vector from 22 to about 170 or so. This also, the result for this was also very poor. The training data, as you can see from my my sheet, the training sample cost declined quite quickly, but the validation data separated from the was much higher than the validation cost by a very wide margin, much wider than in the original two. This also is fairly intuitive, that this large number of interaction terms gives the model the opportunity to overfit much more quickly, which it did. So while the base model found a number of interesting, at least suggested there may be some interesting nonlinear relationships, this model suggested that there really was not much additive power in adding in interaction terms across all of these metrics. When working with time series data in this type of model, one issue is how do you separate the validation from the testing data, and there's a number of problems with just pulling out a random sample. I tried something different in at least in my model 3 here. I actually built an iterative set of models that ran each day. So for my first, so I started on day 250 in my, but I used 5 years of backward-looking data for my entire project. For my first model in Model 3, I looked at the first 250 days, and built a model that tried to predict the following day. Then so my validation data was effectively the following day. Then I rebuilt the entire model, but I added an extra day to predict a model 2 days in advance. Then I kept on repeating this process time and time again, such that all of the so every day after day 250 was effectively in a validation data set, an out of sample set. I actually, to speed up this process, I did it in 2-day increments instead of 1-day increments. But this was a way for me to actually have a substantially larger validation set. The drawback of this was that earlier elements of the data were subject to far smaller samples of data, because I was never able to use data in the future for validation purposes. My final model was the same as Model 3, except I weighted the data by its over time. So for the first model here, I took the first 250 days of performance, but I actually linearly weighted that, giving the first day a weighting of 1, the second day a weighting of 2, all the way up to the most recent day a weighting of 250 to predict the 251st day. The rationale behind this was to reflect that more recent relationships between the data were more relevant for predicting the next day, but balancing that against the fact that you need a sufficient amount of data to build a meaningful model and understand the relationships. The results for Model 3 and 5, which are the last two models I've described, showed fairly somewhat promising results. This table on the left breaks up the future performance of EWA by quintiles of each model's prediction. So the two bars on the left is the next day's performance of EWA for all days where Model 3 and Model 5 predicted those performances would be in the bottom quintile of all performances that those models predicted. And the bars on the far right are the actual EWA stock prices when the Model 3 and Model 5 predicted that they would be in the top quintile of performance. And again, this is all out of sample in that rolling model. So it clearly shows that there is some predictive power, particularly at the tails. Whether or not there's a consistent degree of performance in the middle is not clear on this metric. And finally, probably the most important approach was to do a more comprehensive investment backtest, where I took the Model 3 and Model 5's prediction each night, constructed a market neutral portfolio of EWA and the S&P 500, and then added some transaction and market impact costs, and then took a look at the subsequent performance of that basket over time. The size of my investment each day was proportionate to how big a performance move the model expected EWA to have overnight. So the bigger the expected move, the more dollars I simulated putting to work in the next day. And here's the results of Model 3 on the left and Model 5 on the right. So you can see that Model 5 did show the best results, although after transaction costs, which is the orange line there, really not enough for us to all get rich and retire in the stock market, unfortunately. Not surprisingly, when COVID hit earlier this year and markets became much less efficient, this type of model started to work very well. It quickly picked up on more recent market behaviors, It took advantage of the fact that other arbitrageurs that look at similar patterns had less capital deployed because they were in a very risk-averse mode, and so this type of model, at least in the simulation, was able to capture very substantial returns during those periods of dislocation. In practice, of course, any investor would be more wanting to be more risk averse during those times, and might also have been reluctant to trade aggressively and capture those profits. But it certainly was. There certainly appears to be some statistical significance behind the predictive power of the final architecture I designed. Thanks.